Hello and welcome everybody. Welcome to this Sunday's live stream. Hi Siddharth.
Hi, good morning, Sonam, and good morning to everybody who's attending the live.
Yes. Uh, so we are at the end of the year right now, and it's a very interesting time. You're seeing a lot of positives coming out from the economic news standpoint, but still there is an underlying fear, right? Inside the markets where people are thinking that is it like a scary market, is it a bear market, is it the right time to invest or not? And that's what Siddharth, we're getting from clients also, right? There's a sense of fear,
Yes,
right?
yes, absolutely, absolutely. Especially when we see the happenings in this the start of this calendar year, right, where the market did see some drawdown. There was volatility because of the Trump tariff. I think that
Yes,
is the concern of the investors that what's going to happen again? Is it a bear market that we are looking at?
definitely. I think people talk about that. Plus, I think there is uh, I mean, I think there's a concern about a lot on the macroeconomic front. Right? People don't understand exactly how the macroeconomics would impact the market, and then there's a concern. So that's what we would try to address in this session, right? I sort of believe and I think, see, year enders typically, so that we have been forecasting, right? Whenever we come to year ends, we sort of forecast what's going to happen with the markets, right? But what it seems like is it's very difficult to forecast this market. But what we can do actually is analyze what's going underneath in the economy, right? And that's what we will try to address, and also share a little bit about our portfolios, what's happening there as well, right? Okay, so I have a quick presentation for people. Uh, what we're going to do is try to analyze from the economic standpoint, right? How do things look like? And I think we posted a video also last week, right, about are we in a bear market? And the analysis, what we said was that, okay, uh, it's not the best market, it's not a crazy bull market, but it's also not like a scary bear market. And you can analyze that based on a number of macroeconomic factors. um, on the other hand, I can see various sectors actually do well, and we'll talk about those sectors in this presentation. Our portfolios, in fact, have been pretty robust. If you look at our factor fund, it saw some volatility at the beginning of this month, but then it has recovered quite well. Uh, and then I think on a 6 monthly performance standpoint, we're doing pretty well. Even on a 3 month performance standpoint, we're doing pretty decent. So this fund seems to be doing pretty well. On the alpha front, I think there was a lot of damage that happened at the beginning of 2025, right? So that is something that we are still sort of paying for. We saw correction and then we hedged, so we did not participate in the initial recovery. But the fund, alpha front, is recovering pretty well. So I'm thinking, I'm hoping for good numbers coming out here as well, right? But yeah, I think we are actually quite positive, Siddharth, about the prospects of what's happening in the market. I think our sector allocation in these funds is sitting right, and we actually think this is a good time to top up, especially because if you analyze the performance of the market in the last 5 sessions of December, right? It's a very interesting report that we saw, and I'll take you guys through that. That if you analyze performance in the last week, and this is for all the different sectors that are there, right? On Nifty, you'll see Nifty small cap, mid cap have 100% strike rate of performing well. Autos do really well. Consumer durables, healthcare. This is a phenomena that tells us that there's a strong trend that the last 5 days of the year tend to be stronger, and we are seeing that, and that's why we actually given a message to clients that if you want to top up, that should be a good opportunity. Having said that, let's go and analyze the economic scenario, right? So first thing that we'll do is, we'll just cover this fact that okay, the numbers look really good on the economic front, so that RBI has upgraded the GDP forecast. The nominal GDP has grown quite well, but inflation is really low, right? These values are attractive, but there is a softer underbelly, like they say, right? That headlines are really strong, but there is an underlying fear in the markets, right? Even I think there's been a very big positive move with the liquidity support, right? So I think RBI has been sort of uh, reducing the rates. Similarly, you would see that there have been liquidity measures, there have been open market operations, etc., that have been supporting liquidity in the market, and that is a positive, right, out there. Even on the global front, we saw a rate cut, and there's an outlook that there could be more rate cuts that could be coming, which would be actually a positive, right? In terms of currency, there has been a weakness in the rupee. There's been some recovery in the last few sessions, but then uh, INR has depreciated quite a bit. And that's not a positive sign. That's always a negative sign. If our currency is depreciating, obviously it's a negative sign. But there's certain sectors in the economy, like the IT sector, pharma sector, that various chemicals that export a lot, right? And these exporters actually do well when there is a depreciation of the INR, right? So that's also a positive, I mean, for certain sectors, but obviously that's a warning sign. Now let's go and talk about what's happening in the macroeconomic front, right? So I've been spending a lot of time looking at different macroeconomic indices, and we have got a macro score for the Indian economy. This looks at a number of internal macro variables, and what you can see is that okay, our macro rating sort of reduced a lot during March when the tariff situation happened, right? And that started impacting India. But there's been slow recovery. We're not saying that macroeconomically India is on a very bright spot like the headline numbers say, right? Headline numbers, strong GDP, strong inflation, etc., make it look very attractive, but we think that the global situations has an impact, and macroeconomically India has been impacted, but it's better than where we were at the beginning of the year, and we're seeing an uptrend happen in this scenario. And obviously on the trade deal and the tariff situation also, there's a lot of negotiation that's happening. You can see stocks that are impacted by the tariffs somehow are recovering. So that's a positive sign. So I think that is one thing that we have to sort of acknowledge, that okay, we are not in the brightest of economic spots, but we are not in a bad spot either, right? If you look at liquidity in the system, right, I think liquidity is very important to understand what's, how much the markets are supported. And you see that the liquidity has been pretty robust, and that's primarily because of your the rate cuts and what the operations that the RBI has been doing, right? In terms of, if you look at global macros, which means how are the US Fed and the US economic scenario doing, you see that the US economic scenario in fact was much more impacted around Jan than India, but then it has actually recovered quite a bit. I think the Fed rate cut, and I think there has been the end of the Israel-Palestine war, etc., that have come into play, and I think the global economic scenario is sort of improving a little bit, and I think that can actually be seen in the base metal prices. It's that I think if you look at copper, gold, silver, zinc, there's been a big rally that's
Yep.
happening, right?
Yes.
And that's a sign of positivity in from the economy. And I was actually talking to an journalist recently who was asking me about uh, copper, zinc, right? Hindustan copper, Hindustan zinc. There's been a very significant rally in these stocks, and how long does this stick? So I sort of believe that rally could continue, given that this is strong underlying commodity prices rally that we're seeing. But I think the tariffs and the uncertainty from the US make it a little susceptible. But then I think there are a lot of positive signs here. If you look at market trends in investment flows, we'll first of all look at the valuation index, right? So here you'd see that our valuations improved around March because the market corrected quite a bit, but then since then it's been sort of stable, right? We're not at the lowest of valuations, right? We are I think there is still a little bit of valuation worry in certain segments in the market, and there are promoters selling and PEs who are selling, right, which is a little bit of a worry that you see because the valuations are still high, but I think we're not at the worst situation in terms of valuations, right? And I don't think that there's a massive valuation worry that could derail the markets right now, right? In terms of FIIs flows, they've been reducing this year, right? You can see that there's a lot of reduction in FIIs flows, and you see it all over the news. When will FIIs stop selling? Somebody was asking me that, and I think FIIs might not come back like a flood in this market, right? I think in the previous few markets, in previous few years, you've seen just like when the FIS came back, they came back like anything. That was when there was an excess global liquidity, when there was a uh, this QE happening and all that. There was excess global liquidity, but that's not going to happen because the US is worried about their debt also. But yes, I think FIIs are going to come back in a tactical and selective fashion, right? So that's what you see, that there has been some FII buying, but it's been very selective and tactical, and that's what the nature of this market is. That not everything is going to work, and especially stocks that are overvalued might not work. But then selectively, you'll see many pockets where people will invest, and that's where FIIs would also come in, right? Domestic flow through the mutual fund, SIP, etc., continues to be robust, which is supporting liquidity into the market. So I think one big question that people would have, Siddharth, is where do we invest, right? I think we covered a little bit about the valuations. We talked about the liquidity. We'll also maybe quickly talk about the risk profile that people have, right? So we talk about our fear and greed index. I'll just quickly open that up as well for people. Yes. So if you look at the fear and greed index, you'll see that we especially from the end of November to December, there's been a lot of dips in the fear and greed index, in a lot of dip in the market sentiment. But we did recover in the last few days. The Santa Claus rally, or that end of year effect seems to have come back, and we actually expect the sentiment to be we don't have a lot of fear on the sentiment front. So I think if you're looking at the economy right now, there is liquidity support. Valuations are a little bit of a concern, but not that glaring, right? Uh, and I think market sentiment seems to be fluctuating, but a lot of positivity coming in. So it's not the best market, but it's not a horrible scenario either. What we really believe is that selective investing, which means finding the right pockets, is what will really help, right? And that is what we'll address in this part, which is where do you invest, right? Where do you sort of selectively invest? So this is something that we have. There was a very good report by Nuvama that I picked up this from, and you'll see that there are three sets of companies that can really work in this market, right? So when the market is not extremely rewarding, when it's not a crazy bull market, how do you invest, right? And that's where these three buckets of stocks are providing support, right? So first bucket is those companies where you're seeing restructuring happen, right? A lot of companies which are at their bottom right now, but they have no, the bottom is consumed. You can't go down any further. in the cycle. So, for example, consumer durables, if you look at the AC stocks and a lot of white good company, they are at extremely lows right now. Margins are low, but because the policy is shifting towards consumption, right? Government policy is really looking to boost consumption in the economy. These companies which are restructuring at the bottom could be a good place to invest, right? So I think that would be one call. Second, you see that there are certain sectors which are stabilizers. For example, you have your transmission companies. We do have a few transmission companies in our portfolios also, which have been there, which are doing robust. And then you have bank stocks, right? For example, a number of banking companies and NBFCs, in fact, have been doing extremely well, right? If you look at the Bank Nifty, the PSU Bank Index, the NBFCs, they have been pretty robust, and I think there you'll find a lot of opportunities there. I think gold financing is really picking up. You'll in fact find winners over there. But I think you have to be careful about the gold and silver prices. They're at an extreme high levels. Then you will see the big but these are slightly you might not see, you might see slow growth with the restructures and the stabilizers. But where you see fast growth is the reinvestors, which means companies which are doing capex, right? I think that is where that's been, if you were in a bull market, companies doing capex and giving good numbers would have been like a no brainer. They work extremely well all the time, and we tend to be a little bit biased towards those companies, right? In our portfolios, we are always looking at those growth opportunities, those outperforming stocks, those exceptional performance in any market. But this market has its own set of risks, right? Because Siddharth, you would have seen that, okay, company that's doing capex, growing fast, great execution tends to do strong in this market also. But the moment there is a negative news or a earning
Yeah,
hit, it gets hit badly, right? So I think that's
correct.
where you have to be a little bit careful. A lot of industrial stocks sort of fall into this basket, but I think it's the most interesting part of the market, finding opportunities in this basket. Now there will be certain companies like ITs and telecoms where there's a high free cash flow yield, plus the global India's currency depreciation provides a cushion over there, so that could be something that you could invest into. But I think there will be certain segments where even in the industrial bucket, which is looking really good, there would be some weakness there as well. So now we'll just cover some of the sectors in this session. So this is the recent performance of the market. You would see that metals, energy, infrastructure has been doing much better. But your consumption index, FMCG, IT, PSU banks have taken a hit, and this is just a week performance. Some of the companies that have done really well are Hindalco in the metals basket, etc. And then on the mid cap side, it's been a mixed sort of a bucket, and then you see a lot of banks, etc. have picked up. But yeah, what you would see very interesting on this slide is that while one metal stock is doing well, another metal stock is not doing well, right? While some IT stocks are in the top, and there are certain IT stocks that are not doing well also, right? What that really tells you is that it's a selective market. It's a narrow market where you have to find where to invest. You can't just take that bet, ki, okay, this whole sector or this whole index is going to give me outperformance, right? If you look at this is a very interesting chart, Siddharth, that I look at. I'll just maybe go to the live chart of this one, right? So this is your uh, small cap versus Nifty, right? You'd see that the ratio of small caps versus Nifty sort of became, and I'll just go to the monthly chart because that's very interesting to look at. So here, if you look at small caps versus Nifty, there was a big depreciation that happened over the past few months, right? And if you add the technical indicators to it, you'll see that we were at almost very uh, undervalued level, right, in terms of small and mid caps. And if you go to uh, the weekly chart, you see that the small caps in fact have picked up, right? If you go to daily charts, it becomes very clear, right? If you look at the daily charts, you see that the small caps, after hitting that bottom, have in fact picked up pretty consistently compared to large caps. And I think that trend I sort of see and I anticipate. I also tweeted somewhere around this, that okay, small caps are undervalued, and I think that was a great call. We also report some technical reports on it, right, which was interesting. So small and mid caps, they have some support technically, and I think selectively you'll find a lot of opportunities in that segment. Now let's look at where do we invest in this market, right? So the first thing is that you have to find those pockets where earnings still have oxygen, right? Growth is narrow, right? What that means is, it's not a blanket growth phase, right? It is a narrow growth phase, and you have to find those opportunities where earnings have oxygen, right? uh, so you will see that the revenue growth in India have sort of converged near 10%. Margin expansion has is behind us. You've seen a lot of margin expansion, and alpha right now would totally depend on the balance sheet strength and the capital discipline of the companies, right? If you look at sector dispersion, you'll see that you'll see a dispersion in sectors, right? And but yeah, I think if you're looking at the earnings cycle, you're seeing them slow recovery happening over the past 4 5 quarters. This is mostly margin led. You're not seeing um, very strong growth coming out from a lot of companies. You're also seeing that companies are very selectively doing capex. Either they are doing cash discipline, or there's some instances where promoters are in fact selling into the rally or selling into the market. But uh, but in fact there is a lot of there's some positivity coming from the earning scenario also, and finding those pockets, right, where earnings have oxygen would be critical to find the right investments. Second thing we want to talk about is sectors that can gain from this weaker currency. INR at 90, almost touched 91, I think. Um that sort of is where you'll find certain sectors in which actually gain from that weakness. So, for example, IT, pharma, that's a very age-old rule. So that I remember when around 2012, 13, right, when the rupee had really depreciated around the Greek crisis, etc. That time, people just rush towards IT, pharma, right? And I think in a weaker market, IT, pharma, chemicals, which export a lot, can find some support, or absorb a little bit of a shock, right? So that could be an interesting place to look at stocks. I think pharma is getting a lot of attention. I see a lot of analyst meets happen about the pharma sector, and there are interesting opportunities in this segment that you can pick up. IT, I think it depends on the global growth scenario. It depends on a lot of external factors. Now AI is impacting, but you are seeing movements in that sector, and I think it is something that we have to watch out for, right? I think it could be an interesting sector in this particular scenario, right? Chemicals, again, there's a pressure from China because they are selling aggressively in the global market, but if that sort of eases, that could be a positive sign. And I think the weaker currency sometimes supports certain stocks in the chemical segment. Now let's talk about the next segment, which is financials. Right, in terms of financials, you see that there's been a lot of stability. You see Bank Nifty, in fact, has done really well. PSU banks have done really well. Uh, but there are some. It's not exuberance like they say. The loan growth has moderated. There is some deposit pressure. Rate cuts have been supportive, but NIMs have their upside capped. So here, some larger banks could in fact be better than cyclicals, and you still have to focus on balance sheet quality and fee income, which is strong across the banking sector. But what we think is that the banking rally could, we could be at the, we don't see a massive rally happening in the banking sector, but there would be a lot of support from this sector, right? And this could be a good place to be. Now let's talk about industrials, infra, power. So this is where you see a lot of capex plays, uh, interesting opportunities. We do have a few infra stocks in our portfolio which have been really supportive, right? So over the past 3 months, our portfolio performance has been pretty robust, and that's primarily because we had allocation in the industrial, infra, power segment, right? But again, there's been the capex has been done by the government. The budget is coming. So people are anticipating more capex. That's why you're seeing railways, defense, etc. do well. But you have to look at that very carefully, right? You can't just expect a blanket capex. It has to be selective. There are in fact certain segments in the transmission and distribution part of the economy. I we've had like couple of stocks where we have invested, but then we reduce our exposure in one of them because there's some government policies that are reducing the demand scenario there. So you have to look at that. uh, but uh, but I think there are still very interesting opportunities in this segment where we continue to be invested, right? Another thing that people would talk about is consumption, right? I think the policy by the Indian government is totally towards consumption in this market, right? The Indian government is trying to boost consumption in the economy, but still you're not seeing that result come out, right? The rural consumption is still fragile. Urban consumption is also very uneven. You see certain pockets where there are positives, for example, around the wedding season, around certain segments in terms of the consumption play where you've seen good numbers. But then there's been a lot of unevenness in this market also. So it's not a momentum market in consumption yet, but I think there's a strong outlook, right? Yeah. So if you see, there are there's not a crazy momentum that is happening in the consumption basket. But if you look at next few years where you would see strong support, that might be consumption. So I would not say that next month, next quarter, there's going to be a rally, but you have to be a little bit patient for the recovery to come here, right? So, if you're looking at it on an aggregate level, what I would say is that it's a high performance athlete that India Inc. is. There is a lot of fitness in the balance sheets, but the demand has been seen to slow down, right, which is a cause of concern. And in this market, what would do well, you know either you pick up those restructuring companies like we talked about, consumer durables, etc., where they are at a bottom, where you see some pain and they're recovering from pain. That could be good opportunities to invest into. Or secondly, you would see uh, there are those capex stocks also, companies that are doing extremely well, and we have a few stocks like that. If I could name again, we might have positions in those stocks. But you see in stocks like car trade, you see in stocks in the auto segments. I actually presented on a company called Lumax Tech in this investing accelerator summit that happened to that, right? And it was very interesting presentation where you'd see that
Okay.
yeah, the company has seen a strong growth, and they have a very strong fundamental philosophy within their company also. So there are pockets where you're seeing this strong growth through capex, etc., also. But then you have to be careful, right? You have to be careful of the volatility, liquidity over there, right? And I think valuation is still something that is not the brightest spot yet, right? I think if we are at a valuation but earnings are not growing that fast, either earnings catch up or the valuation is correct. uh, we are seeing signs of earning catching up, but valuation is something that you have to be careful of. And I think you see this narrow market with opportunities coming across the board, but it's not like a euphoric bull market yet. So that is what I had prepared for this, and I think we have a lot of
Right.
questions to go on to, right?
Yes, we do have a bunch of questions and we'll try to address them explicitly, right? Firstly, thank you for the presentation, Sonam. This gives us a lot of insight and the investors a lot of insight on what's happening and what might be the way forward. Um, You were talking about various signals during the course of the presentation, where you were trying to highlight that these signals might define a bear or a bull market or a choppy market in that sense, right? But which is the one most trustworthy signal that you actively track to define the market regime?
See, I think in the short term, Siddharth, I think that fear and greed index is something that we look at, but it's very short term, right? It goes from fear to greed very fast, right? So it's not a regime signal as such, right? If you're
Mhm.
looking at the market regime, I think, like I said, so there's no one signal, I would say, but I've been working on a lot of these broader signals, and we talked about valuations, we talked about liquidity, we talked about the fear and greed, the risk sentiment, etc. uh, I think right now a lot of signals coming from the US, right? For example, the US inflation rate, the US Fed rate, etc., are extremely important. So we incorporate that. Even commodities, what's happening in the commodity markets, gold, copper, even Bitcoin, what's happening over there. So there are a lot of signals, a combination of which tells you where to invest. It's a multi-dimensional scenario with macroeconomics, right? It can't be like one thing that tells you where to invest.
Right. Absolutely. In the most recent newsletter, we also mentioned that the indexes were looking calm, but stocks are still struggling in some sense, right? What usually breaks first, earnings, breadth, or liquidity, and which one are we watching very closely at the moment?
So we are watching all of it. I think there's no worry. I mean, I think in the liquidity scenario, we are not in the desert of liquidity. There's a lot of liquidity support. We are in a rate cut cycle, right? In fact, so not that worried about liquidity. Obviously, the foreign liquidity, might not come like crazy because there's still selective buying that's happening, right? But even from the Indian market, there's a lot of liquidity support. So I'm not that worried about it. And I think market breadth has been selective, but we are not in the worst case scenario of the market breadth.
Right.
Valuation is something that we have to sort of carefully look at, and I think a lot of signals coming from the global economy and the commodity prices are what is very interesting in this current scenario, right?
Right, absolutely. And a little bit on sector positioning. So in this environment, do we prefer stocks that benefit from falling rates, as we were discussing, stable cash flows, or improving earnings, or a bunch of all of this?
Yeah, I think it's a bunch of all of it, right? And I think that's where I see, because see, we are a quant fund, right? So we don't go and choose sectors as such. Our strategy don't go and select sectors, but the stocks are selected based on a number of metrics, right? And what we see is that in our portfolio, it is a very fair mix, right? I see right now a lot of interesting stocks from the auto segment have got an allocation, and then you're seeing the auto rally actually play out quite well in the recent times. Then you along with them, you'll see there is allocation in the energy space, in the capex cycle, in the industrial space also, which is working well. There are consumer stocks also in our portfolio, maybe not very heavy allocation, but there is selective consumer, even some tech, a lot of materials, right? So, for example, on the metal segment, we've taken a bet. Even we've taken bets in chemical, cement, etc. selectively, right?
Right,
So I would say
right.
that there are selective opportunities across the board in this market, right?
Right, absolutely. Shifting the focus little on the strategies that we have, what would you like to say to investors who joined us, whether it's through our small case offerings or PMS offerings, by the end of 2024, right? During November, December of 2024, who've been with us in this journey for almost a year now, but haven't seen those numbers kicking in. So what would you like to share with those investors, specifically with those investors?
Right. I think that's when we actually, in fact, on the PMS, that most of the investor addition we saw uh, around late 2024, right? Because we were a year-old fund at that time, and that's when
Right.
people started picking up. Really started picking up, and you've seen. many investors see some impact, right? You've seen people seeing flattish return over this year because we did not deploy very fast for those clients, right? And I think little bit worried about what was happening before they invested and what's happening after they invested. So again, what I would give you, what I would like to tell people is that you know investing strategies like what we run are uh, are again, we are highly susceptible to what's happening in the market, right? I mean, we can't change what happens in the market, and that will have an impact on the strategies. But in the long term scenario, we do see exceptional numbers coming from our strategies. The period like 2025 can happen, and historically also there have been scenarios like that can have an impact on our strategies. But I think on if you keep invested, right, I would see a stronger outlook even in the next year, right? In fact, I would not say that it's the year where you're going to get 70%, 80% returns. I will
Right.
not say that, but we expect better than average returns, right? I think uh, aiming for a 15, 20, 30% would not be wrong, right, in the upcoming
Right.
years. And I think the numbers will come. I think we have to look at what's happening in the world, and I think our strategies are extremely robust in picking opportunities across the board. We are also improving certain signals, like we talked about. What we are doing in the economic scenarios is that, in fact, there are some signals we are studying to improve our regime model. And
Right.
yeah, I think so I would just say keep invested. This is part of the market, right? See, why you invest is because you expect markets and strategy like us to give you a better chance of wealth creation, right? But the
Right.
reality of it is that okay, it's not a bond strategy, right, that just goes up. It is betting on stocks which will have some ups and downs, and there can be periods where you have some volatility for a longer time, but then lo- later, you'll see the numbers come in. And I think that's what I really appreciate people who have been very patient with us, and I think they'll see the results come in. I'm very confident that we'll see those results soon, right?
Right. Absolutely. In the current context, from a fund manager's point of view, what is the most common behavioral mistakes that you're seeing across investors at the moment, so that investors can look into it and not, sort of indulge in those mistakes and rather
Yeah.
be invested?
So behavioral mistake, I think, see, what we can see is there are people who might be, you're seeing that we are at, I think a lot of fear is playing out, right? If you are on Twitter, if you're following different, even on, I mean, I look at a lot of YouTube videos on AI and valuations in AI, etc., right? And that tends to instill some fear, right? I follow Michael Burry. I'm sure you do also, Siddharth, right?
Of course.
And
I
yeah,
think
yeah,
I think we all do from the Big Shot. I think he's gotten famous, and then we've sort of been following his approach.
yeah. So that guy is betting on the AI stock correcting a lot, right? But I think those type of fears are there for investors, right? When you see such type of news, you're worried that, okay, why am I investing in equity strategies? But I think the AI industry, the valuation over there is very different from what's happening out here in India. I think that's why this presentation, it seems a little bit boring with all these charts and all, right? But but see,
Right.
at the end of the day, you have to understand the real picture, right? Okay, uh, if people are talking about fear and all that, what is going to impact my portfolio actually, and what's happening out there, right? So we don't see any. I mean, obviously, there it's not the best of the market, but the scenario is could turn positive also, right? So that's what we see. And I think what investors have to do is just invest for the long term, right? That's what. And I think what we
Right.
have to do is follow that process, right? So just two key things: one is stay invested, and second is to follow that process continuously.
Right, absolutely. For a quant-driven firm like us, when investors are comparing our returns, especially in the past year, to benchmarks, right, which are the broader benchmarks, and they are seeing that the performance is not there, but the benchmark is performing better. right? In this case, is there any guidance for investors to look at other benchmarks for our strategy specifically, or should they still stick to the larger, broad-based indexes as the benchmark itself?
So see, I think in this market and in my newsletter also I talked about this, that okay, Nifty, if you look at the index, it's been stable, but go inside, right? If you are going to the broader market, you're going to selective stock, you're seeing a lot of pain happening across the board, right? And index like Nifty or BSE 500, which has a huge allocation to large caps, has been more stable compared to selective strategies. And so see, the right benchmark for our strategy might be, let's say, the Nifty Momentum Index, or a combination of Nifty Momentum Value Quality. Right, there are certain indices that follow that distributed approach also. Those might be a better benchmark. You could benchmark us with a multi-cap index instead of the large cap, right? Because we do have allocation to small and mid caps also. So I think that would be the right benchmark to look at, and you'll see that we are, if you're comparing with those benchmarks, then we are not doing worse than the benchmark. Right? We are pretty much
Right.
similar to the benchmark, right? So yeah, I think this is what a scenario is, that okay, large caps are playing well, but there's been a some pain in the broader market. And I think the trick right now would again be not just the index, but on the selective stocks only, finding those right opportunities is what would work.
Right. Another interesting question on portfolio construction and discipline, and our recent newsletter was around that as well, right? So in a range, let's assume that the next financial year would be like a range-bound market in that sense, assumption, right? How do we protect our portfolios from being whipsawed in a range-bound market? What
Hmm.
tells you to be patient as a fund manager, and what tells you to actively rotate the strategy?
So again, see, actively rotate the strategies. I think that is something that where we got impacted, right? I think in January we had allocation to high momentum stocks. You had small and mid caps, you had capital market stock, etc., which got hit badly, and then we sort of sold when the market was really going through a downward trajectory, right? And then there was a recovery that happened for a short span of time. Uh, so yeah, I think see, how do you bring discipline to it? Again, you have to get signals from the macroeconomics, like we are sort of implementing. And then I think this sort of discipline that's built into our strategy, you will see that inherently it's not a very high churn strategy. Even in a if you look at the turnover, there is turnover that happens when the cycle turns, but otherwise it's not a very high churn strategy. It seems a relatively low churn, and that's what we see happening, right?
Right, absolutely. I mean, if you look at it on a macro perspective, which is translating into the markets, right? In the
Hmm.
next 12 to 18 months, especially for the equity returns, from growth, inflation, or liquidity, which is the largest macro that you're looking at and why? If given a choice to choose one among these three,
Growth, inflation, and liquidity.
growth, inflation, and liquidity. Because we've been talking about the multi-dimensional approach, but if
Hmm.
given a choice, which is the largest macro that you see the equity markets being impacted in the next 12 to 18 months from these three, growth, inflation,
I think,
and
see, growth,
liquidity?
I think the growth is the biggest thing that you have to look at, right? Because liquidity is stable, inflation is at a relatively low level, but growth is slightly deceptive right now. You're not getting this broad-based growth. You're not seeing, companies have cash. I think balance sheet is very strong in India, right? Companies are managing balance sheet strongly, but then what next, right? What do you do? If you're not seeing a lot of demand, then why do you do capex, right? So I think the demand environment and the growth as it comes back, that would be the most critical thing to look at.
Right. Shifting focus to our strategies again, if you look at a strategy like Alpha, the performance has not been that great in the past year compared to all other strategies that we have, right? So, what would you advise investors to hold such a quant strategy still in their portfolio, or to come back to these strategies once we see that momentum in the market, especially for strategies like Alpha, which are concentrated?
Hmm. No, I think Siddharth, I think alpha strategy can be scary in a slightly bearish market. For example, in January, right, when we had concentrated bet in momentum stocks and that got impacted last year, then people think, oh, there's something wrong with the strategy and all. But if you look at that, right now it's an extremely robust strategy, and like you've seen, faster correction, the faster recovery would also come due to the nature of how the strategy works. And I think we are. I'm extremely comfortable with the strategy. Actually think that's would be our best performing strategy in the long term. We have a 2 year performance numbers, but we have a long way to go. I think pretty soon it would be the best performing strategy within our portfolios. And yeah, I think we see that trend. I think that's the one trend that I keep on seeing, that some of our investors occasionally they're shifting from alpha to factor in our PMS, right? but
Right.
uh, but I think it's a extremely robust strategy, and people invested here, you should understand why we have that conviction here, right? Why it works. Happy to have individual calls with clients who have that question, but we remain extremely confident about the particular strategy.
Right. In markets where investors are chasing returns, asset allocation becomes extremely important. Hence, in our strategies, do we plan to have asset allocation towards precious metals like gold, silver, so on and so forth, just to generate alpha?
Yeah, we do that. And I think we've been looking at the precious metals, but it's always difficult to find a conviction to that okay, this is okay, okay, we can buy gold or silver at these levels, because those levels are slightly inflated right now, right? But we
Right.
do have that allocation, and we have that as a critical part of our strategy.
Right. Absolutely. I think we've tried to address the maximum questions that have sort of turned out. In case we've missed any, I've dropped in our emails in the chat window. So we'll request investors to email us their questions and we'll take it from there. One last question from my side, Sonam, and then probably you could wrap it up as well. So if this year turns out to be a low return, high dispersion market, what should investors reset their expectations to in terms of returns, volatility, and time horizon?
Right. I think that's a very interesting question. I think, see, this year, I have a positive sort of an outlook. I don't have, I think a lot of fear that happened. So 25 is built in. I have a slightly positive, optimistic outlook, but then it's not going to be that crazy year of 70, 80%. I don't have that outlook yet, right? And,
Right.
nobody can forecast what's happening. Um, so I think, see, again, selective picking, understanding fundamentals, why the company is a good investment option right now, understanding valuations, right? That is that valuation justifiable or not, right? I think that would be critical. And yeah, I think we'll find opportunities across the board. So we'll find opportunities in value stocks which are coming from some sort of correction. We'll find opportunities in these fast growing stocks, right, which are doing capex. You'll also see stability in some of slightly larger stocks or sector around. So you see opportunities across the board, but you'll have to be selective, and you have to be very careful about the fundamentals and the valuations.
Right, absolutely. Sorry, one question again. Let's assume an investor has 50 lakhs capital to invest today. Should he just buy four, five small cases, or should he look at the PMS route and why?
See, I think it's totally up to you. I think if you're doing 4 or 5 small cases, it will be a much more diversified sort of a allocation. But yeah, I don't think that that type of diversification sort of helps you when there is a slight volatility in the market, because everything is impacted. I think if you're taking a bet with a PMS that you believe in, that could be a much more confident sort of allocation, and a slightly focused allocation for you to invest into. Also, I think operationally might be slightly simpler for some people to go with the PMS. uh, so I think there are positives and negatives on both sides, and I think it's totally up to the investor to choose the vehicle they sort of want to invest with.
Right. Absolutely. I think it is also more dependent on the type of investor you are, right? If
Yeah.
you like managing things on your own and you don't want to outsource it, then maybe small cases might be the way to go. But if you want us to do everything for you, which is an actively managed strategy in the PMS that we have, then you're always welcome to invest with us. That's all from my side, Sonam. Any last notes from you for investors for the coming year?
So for the coming year, see, I think we're not making any forecast today, but we, like I said, we are looking deep into the numbers and we have a positive bias, and I think more than a positive bias, it's going to be an interesting market where you're going to see opportunities across the board in a selective fashion, and that would be a important thing to do. A strategy that can do that, Siddharth, selectively pick those opportunities will actually give you that outperformance, and that's what we believe our strategies do. So we're excited about the coming markets, and I hope our investors would be excited too. And yeah, I think we'll just wrap up by wishing everybody a very good and a very happy new year, and I hope they have a great time in the market and in their lives in the upcoming year, right?
Yes, no, absolutely. I think, firstly, I would like to thank everybody who joined in on a Sunday morning for attending this session. And probably this is our last live interaction in this calendar year, at least, right? So, wishing all our investors a very, very happy new year. Also, in Hindi, we say kursi ki peti bandh lijiye, because there is volatility that we are expecting in 2026. But just to mention it out there, we are an actively managed strategy. The fund manager and the models are actively looking at what has to be done in terms of the best wealth creation possible. So be rest assured. Anything else, we are always happy to help.
Amazing. So thanks a
Thank you,
lot,
Sonam.
everybody. We'll see you soon. Yeah. Awesome.
Okay. Okay. Thank you.
Thank you.
Bye. Bye.